Commissioner, I believe you're on mute.
Yep, thanks, Matt. A call to order the meeting of Housing and Community Resources Committee. And we'll start with a statement from our legal counsel regarding the governor's executive order.
Thank you. This meeting is being held pursuant to Executive Order 16, as amended and extended by Executive Order 78, in connection with the continuing state of emergency caused by COVID-19. This meeting is being held to conduct essential business of the Board of Commissioners of the Metropolitan Development Housing Agency Housing and Community Resources Committee. The public has been invited to attend, and the meeting will be recorded and made available for public viewing on YouTube via the MDHA website. Official business may commence upon a motion, second, and roll call vote in favor of said motion to proceed with this meeting electronically.
Thank you, Will. So the first order of business is the approval of the minutes from the November 5th, 2020 meeting.
Commissioner Bowers, if I may, if you could call for a motion to proceed with this meeting electronically, that would be advisable.
Okay. I'd like to call for a motion to proceed.
Commissioner Thaden makes the motion. Do we have a second?
Second.
Commissioner Batts, I will call the roll. Commissioner Bowers?
Yes.
Commissioner Ansari? Commissioner Batts?
Yes.
Commissioner Campbell? Commissioner Thaden?
Yes.
3 votes in favor, no votes in opposition. Meeting may proceed electronically.
Okay. If LaTanya's on, I just have a request in the preparation of the agenda for future meetings while we're in virtual space. Would you just add that item that we need to start with the motion to proceed with virtual meetings? So until I remember. Thank you. The first order of business is the approval of the minutes from the November 5th, 2020 meeting. Do I have a motion?
So moved.
Okay.
Second.
Are there any discussion items on these minutes?
Nope.
Okay, none being, then we'll take a vote to approve the minutes as they're in front of us.
Commissioner Thaden?
Aye.
Commissioner Batts?
Aye.
Commissioner Bowers?
Aye.
3 votes in favor, no votes in opposition.
Thank you. Then we'll move to the next item of business, which is the award of project-based vouchers for the project titled Shelby House. And this was discussed at last week's Finance and Development meeting. We had the developer in the meeting with us to answer questions. But this comes before this meeting, and I think Norman is with us today. Maybe Norman, if you'd give us a summary of this and be ready to entertain any questions.
Sure. Good morning to everyone. We have received an application for the award of project-based vouchers for the Shelby House development. It's a proposal that was awarded a $900,000 grant under a competitive THDA National Housing Trust Fund grant. So because they had received an award under a competitive grant, they are eligible to apply for PBVs from MDHA. Like you said, it was discussed in the finance meeting last week, and it's at South 4th Street. It's a total of 474 units, comprised of studio, 1-bedroom, and 2-bedroom units. They are requesting a total of 118 project-based vouchers from MDHA, 27 studio, 82 ones, and 9 two-bedroom units. These are to be completed in 2 stages. 48 is phase 1 completion in December of 2022, and 70 in phase 2 completion in May of 24. So we are requesting committee approval to submit a recommendation to the full board in April for the award of 118 project-based vouchers for this development. Subject to any questions, that is my recommendation.
Norman, I just want to make sure that I'm understanding this statement in the write-up. It says because they received a competitive award within 3 years of the PBV application, they're eligible. I just wanted to gain a little bit more context on that.
Okay, well, the project-based voucher regulations do allow PHA to consider the award of PBVs to these type of other awards received under a competitive application, like a home grant, tax credits, things like that. It is an option that we do have in our administrative plan that we will consider applications for PBVs for any developments falling within this category.
So basically we hold that voucher capacity for 3 years, assuming that the award.
No. Just because we will take an application does not mean we will approve it, or we have to approve it. It's something we can consider on an ongoing basis. Right now, this will put us right at our 900 cap, or maybe just above our 900 cap that we have in place. And we would have to consider whether we want to go above that on any future applications. So we do not have to award PBVs.
Sorry, just to jump in here. So normally, is it accurate to say that we would award PBVs based on an RFP process, but this is an exemption from sort of a broader RFP process to the award of PBVs?
That's right. In the previous awards of PBVs, they did go through an RFP process. That's correct.
Thank you. That's helpful.
Yeah.
And so, Norman, you're saying that this might put us over the cap that the board has previously approved?
Well, actually, the board has approved up to 1,400. The initial cap was 900.
Got it.
And the first 2 RFPs got us right at that 900. But because there was one development that fell through, that we had awarded PBVs, but it didn't come to fruition, we had some extra room under the 900 cap.
Thank you.
So Norman, the board approved a 1,400 unit voucher cap. How many PBV vouchers are there out there?
Currently, it's just under 800. If this is awarded, it'll take us right at or above the 900.
Okay, so there's capacity then for 500 more?
Thereabouts, yes, ma'am.
I think I got it. And is, I guess to help keep my memory fresh, if I want to refer back to this later, is there some sort of explanation document that explains how you go about this, a summary that I could keep on file to refer back to the process?
On the PBV process?
Yeah.
Yeah, it's part of our administrative plan. Yes, I can get you that.
Thank you.
Mm-hmm.
Are there any other questions or comments? Okay. Then is there a motion from this committee to recommend to the board approval of project-based vouchers for this project?
So moved.
Any discussion? Okay.
I second the motion.
Okay, thank you. Then Will? Should we call the roll?
Could we get a? Okay, Commissioner Fader,
Aye.
Commissioner Batts,
Aye.
Commissioner Bowers,
Aye.
Commissioner Ansari.
Aye.
4 votes in favor, no votes in opposition.
Thank you. Is there any old business that needs to come before the committee? Any new business? Then I think we can have a motion to adjourn. Am I right, Will?
Yes.
Okay. Motion to adjourn
So moved.
and second.
And you stand adjourned.
You need to vote, don't you?
We don't vote for adjournment. Or we don't roll call vote.
Okay. Are we officially adjourned then, Will?
Let me call the roll just to be on the safe side. Commissioner Thane,
Aye.
Commissioner Batts,
Aye.
Commissioner Bowers,
Aye.
Commissioner Ansari.
Aye.
4 votes in favor, no votes in opposition. You stand adjourned.
Thank you.
All right. I believe we have a quorum of both the Finance and the Development committees.
I detect a quorum for both. May I call the roll for each committee?
Please.
For Finance and Audit, Commissioner Purcell,
Here.
Commissioner Thaden,
Here.
Commissioner Ansari,
Here.
Commissioner Batts,
Here.
Commissioner Campbell. For the Development Committee, Commissioner Purcell,
Here.
Commissioner Thaden,
Here.
Commissioner Ansari,
Here.
Commissioner Bowers,
Here.
Commissioner Coleman, Commissioner Campbell. We have a quorum for both.
Thank you. And will you please proceed with the executive, summarizing the statement of the governing
Legal counsel. This meeting is being held pursuant to Executive Order 16 as amended and extended by Executive Order 78 in connection with the continuing state of emergency caused by COVID-19. This meeting is being held to conduct essential business of the Board of Commissioners of Metropolitan Development and Housing Agency joint meeting of Finance and Audit Committee and Development Committee. The public has been invited to attend. The meeting will be recorded and made available for public viewing on YouTube via the MDHA website. Official business may commence upon a motion, second, and roll call vote in favor of said motion to proceed with this meeting electronically. I would advise that each committee make its own motion.
I move that motion for the Finance Committee meeting. Is there a second?
Second.
Second.
Will, can you call the roll?
Commissioner Purcell,
Aye.
Commissioner Thaden,
Aye.
Commissioner Ansari,
Aye.
Commissioner Batts.
Aye.
4 votes in favor, no votes in opposition.
And I'd like to move the motion for the Development Committee.
Second.
Commissioner Purcell,
Aye.
Commissioner Thaden,
Aye.
Commissioner Ansari,
Aye.
Commissioner Bowers.
Aye.
4 votes in favor, no votes in opposition.
Thank you. Okay, moving on to the agenda from our previous meeting, we just wanted to wrap up the audit report. So I did ask Debbie and Leanne to join us again today because we just had so much fun with you all last time, hearing all the great news about our financials and the clean state of affairs. But the outstanding item, I believe, was just to briefly summarize the programs that were audited. and then to also just share your key takeaways with us. So let me turn the floor over to you.
Okay. Leanne's not with us today. She's somewhere where she can't get any cell phone and it's my turn to be up anyway, since I couldn't get anything to work last week. So the fact that you can hear me is very exciting. I'm going to try to share something that's really small and very short, but if I can't, we'll probably survive without it as well. Share. I don't know. Did that work? Can you see that?
We can.
Oh, how exciting. Okay. So this is really short. I'm just going to go through some key takeaways and a couple of things communication-wise that we weren't able to get in last week that are just important for governance. So if you want to look at this, this is literally 4 small slides. For our key audit takeaways, I know we mentioned last week, but the most important thing in general is that you had an unmodified opinion on your financial statements, which is the highest level of opinion. We also issued several other audit reports that are included that are on compliance and internal control. So just to briefly say, because of the amount of federal funding that you have, particularly through HUD, we are required to do additional procedures on some of your larger programs. In our lingo, that's called major programs. And your major programs for this year, and sometimes this will differ between years depending on funding, were Section 8 rental assistance and the mainstream program. The important part about that is that all of our reports issued noted that there were no compliance findings, meaning we test compliance in accordance with all of the HUD required items, and we did not find any issues. We also are required to test internal controls specific to those programs over receipts, disbursements, payroll. We did not have any findings in that area either. So that's very good because all of that gets reported to HUD and to your grantor. So it's great to have a clean opinion in those areas. One thing I just wanted to highlight again, there were no adjustments to the financial statements themselves as a result of our audit, meaning we did not find anything that was incorrect that needed to be corrected that management had already done. So I think that's very important to keep in mind as far as the audit. And stop me if you have questions, but otherwise I'll just go through this briefly.
Can you tell me how you're defining, what is mainstream program? Is that CPD?
That might be a better explanation.
I can take that if you may. It's a targeted voucher for non-elderly disabled families. So it has to include a family member who is between 18 and 61 who is disabled. We recently got an additional award of 100 mainstream vouchers this month, in fact. So it is targeted voucher for non-elderly disabled families.
Thank you, Norman.
You're welcome.
That was a much better explanation than I would have given. So thank you very much, Norman. Required communications, we obviously are engaged by the board of directors and we are responsible for providing opinion to your board. So our opinion has to be independent. That's number one, that's most important. But there are other key items that we are required to communicate to you. One of those is that we had no disagreements with management. We did not have any difficulties in performing the audit. We set out our planning schedule at the beginning of the audit and everything was performed as planned. Management met all of our deadlines for providing the information we needed. So we very much appreciate that. Part of our audit encompasses looking at accounting principles and management estimates to make sure they're reasonable, they're in accordance with generally accepted accounting principles. We found none of those to be unreasonable. Everything that we tested was accordance with GAAP the way that it should be. And importantly, we did not note any internal control weaknesses or deficiencies. That's very important because part of our audit is to assess whether the internal controls are strong and that they're operating as they should be. From the audit itself, we went over these. I just left these in here so that we could say, here's the key things from your financial statements, or if you missed the meeting last week. Financial position-wise, you ended the year in a pretty strong position. Operational cash increased about $3.3 million. You funded all of your PBRA contact replacement reserves. That's $47 million of restricted money that you have setting aside for those reserves. Significant things that happened during the year are always going to be the notes receivable and payable. But significant ones for this year were the Randy Rogers, which we've discussed. That's kind of its own category where it will be repaid at the end through the property transfer. And then Martha O'Brien, which is, as we said last time, kind of tried to define not a related party. That one is anticipated to be paid back through cash payments, and you've already received some. Debt-wise, on the debt side of that, new debt was taken out for Bosco Bell 1, Harper Cove Flats, and Kirkpatrick, and those were offset by principal payments on your existing debt. So we had a net increase in total debt of around $7 million, and that is really a key highlight from your entire balance sheet for the year. And then operationally, this was pointed out last time, I know Mr. Ansari asked about this specifically. I think these are great questions. The revenues increased 9.6%. That's a lot of Metro funding and additional CARES funding. That CARES funding hopefully will continue. Expense-wise, those increased obviously more than the revenues. And those are due to the items that we've listed here. So you could kind of see a little outline of what it was that caused those. Some of that I know we talked about where some money came from Metro and went back to Metro. That was $2.3 million, and there were new positions. There were also expenses related to COVID, which hopefully were offset by the revenues that came in from, especially through HUD for additional CARES. And the net income for the year ended up at $10.8 million compared to $8 million last year. So all in all, considering all of the issues that you had, I think you had a pretty strong year. That's my key highlights and takeaways. What questions do we have?
Thanks, Debbie.
Sure.
I'd just like to first start off and say congratulations to Norman's shop and everyone who works on our voucher program. It's pretty phenomenal with how much you're managing on a day-to-day basis to have literally no findings and no issues that had a financial impact. So congrats on great work. We don't thank you enough for all that you're doing to make sure that our vouchers are out on the street and being implemented to their maximum capacity and doing it in such a clean operational way. Any questions moving forward for Debbie?
No questions. I think this is thank you very much, Debbie, for a nice, clean, and concise summary of the financial positions and kind of focusing on the highlights of the audits, which is around compliance, around controls, around governance. I think this is an excellent summary.
And I just wanted to pile on for Norman's group. We had 108, if you look at the last few pages of the audit, $108 million in the state grants, and 62 million of that was with the voucher program and the mainstream. So Norman does great work. So he's going to pay. He's taking me to lunch afterwards. So.
All right.
Well, I was also happy to hear that, Melinda, you're not picking fights with our auditor. So congratulations to you. So really, I just want to say one more time, thank you to the finance team. You guys are doing phenomenal work, and thank you for a great audit presentation. And Debbie, please don't feel a need to stay on the phone at this point. You've given us plenty of your time.
Thank you, guys. Have a great day.
Thanks, Debbie. Appreciate it.
Sure.
All right. So if there's no additional questions, Melinda, let me turn it over to you to present the budget to actual variance analysis.
Okay. And first of all, I just kind of I'm going to practice sharing too. So let me see if I can. I just wanted to do a couple more. Can you guys see this?
Yes.
Okay. Just a couple more key points that some had to do with financial error and not as far as the 2020 the audit report, that we, as an agency, I think kudos to, and you guys know this, we display tremendous financial flexibility in response to the March tornado and COVID challenges this year. We do that, as you know, with the reserves that we have on hand, operating reserves. So we were able to respond quickly toward the tornado damage and cleanup because we do have those reserves on hand. And we have been working with our insurance carriers to get the insurance proceeds back. We'd gotten some back in 2020, and then we had gotten some back in December. So we're still working with, I guess the biggest one is the 10th and Jefferson that's still outstanding, and the roof repair has begun on that. So hopefully the 20 plus units will come back online pretty quickly. And we were able to calculate and report a $9 million 2020 cash surplus sweep from the MDHA managed properties, which exceeded our projections. just wanted to highlight, and I didn't send this out, but I can, just as a guide, that the properties that came on in 2020, either for a partial year or a full year, Kirkpatrick, I think we had a full year on Kirkpatrick, but the other ones came on board, mixed income properties during the year, and then what's anticipated in 2021 coming on board. Then just to kind of recap what Leanne had mentioned last week, that as we close and add LIHTC properties, we'll have more notes receivable on the MDHA primary government side between MDHA and the discretely presented component units, along with the shift will be from an example, Casey, the shift will be from rental income and operational expenses that normally got reported in the Casey pocket and MDHA's books to the discretely presented. So that's as we go forward into the mixed income and LIHTC properties, adding those every year those will shift. But now that the discretely presented component units are included in our audit, it helps, I think, see the full picture. So that's just a couple of things I wanted to pile on to that. And then I'm gonna stop sharing that. And then I think everybody got I'd asked LaTanya to send out the PowerPoint presentation of the budget to actual. Would you prefer that I share it? I know some people like to see the Hollywood squares, or you would like to look at your own version. I can do whatever, Emily.
Why don't you share it, Melinda?
Okay, I'll do it. Am I sharing the right thing? First quarter?
Yes, that's
Okay.
great.
Okay. So this is the first quarter budget to actual variance analysis. Saul had mentioned, and we didn't do it this time, but we will next, that we just chose to explain variances of 5% or more. But next time we'll do I think Saul, I think we talked about yesterday doing a 5% and 250 or a 500,000, because some of the 5%, but the numbers are so big, 5% is pretty significant fluctuation. So we'll explain that, those two things. And I did do some notes. I just don't have them here on the screens that you guys have, the version. But just went through, I'll just kind of do some highlights. Again, I'll note, even though it's a 3% variance on HAP income.
Hey, Melinda, can you hear me?
Yes,
Why don't you start at the bottom line, which shows kind of what
okay, sure will. Okay, I'll do that. Yes. Okay, so
and what do you think? When do you think we're going to catch up by the end of the end of the year or whatever?
Yeah, and then if you guys have any detailed questions, yeah. Okay, great, good idea. Thank you. So this column, this is this. And Aoli, this is what we had presented for the 2021 budget. So we went back and reworked the numbers and put the 2021 budget into this format. So we have the total budget here in the first column for 2021, and then the actual from October through December for the first quarter, and then the budget for the period divided out by 12. Divided by 12, multiplied by 3. So, so the bottom line is we ended the actual December 31st first quarter with a $304,000 actual net income, or add to our equity, strategic equity. We budgeted 1.1 million. The difference is it's mainly a timing difference. We receive the TIF admin funds. We get those. We don't get those until probably end of April, 1st of May. So, and that's about $1 million for the whole year. So you figure that's a $250,000 quarterly add that where Joe in urban development, their group, that it pays for their admin cost. So we have not received that money yet in this fiscal year. But we'll be getting that in I say second quarter. I really meant third quarter. I was thinking calendar year, but it will be in April and May. So we'll get that all in a lump sum for the whole year. So that's part of the cost of urban development's department is in this with no revenue right now, but we know it's coming. So that's just a timing difference. And the other part is some of the developer fees that we had anticipated getting in December for Boscoville 1, CP2, and Curve Victory Hall. Because we are waiting on THDA to get our 8609 forms for those projects, we were not able to recognize and report or receive, I guess, from the investor partner developer fees for that first quarter that we had anticipated. It's about $450,000 for the 3 of those projects, but we do anticipate getting those hopefully by June of this year. So they will be recognized, those developer fees that we count on coming into the central office to cover central office costs will be coming in hopefully in the by June, by the 9-month period. So that's where we are. Sorry.
Those 8609s are something that I'm going to talk to the chair about as well. We might want to make a call to THDA because they're way behind on those.
Mm-hmm.
We need THDA to certify those so we can both access our low-income housing tax credit, equity, stop paying interest on some construction loans,
right,
and also get our developer fees. So we need to, they've just been, with COVID, they've just been really behind.
right.
So unfortunately, out of our control. But go ahead, Melinda.
Yes, we have to.
Oh, you're a little hard to hear. If you could just move closer to your mic. Thank you.
And I guess you guys, can you hear me okay? Okay, great. Okay. So for the first quarter, that's where we are. We ended up, again, timing differences. We know the money's coming in. The variances between revenue and expenses are highlighted here and explained. I can go through each line item if you want, or I know you guys have had it now for a little over a week, and I'm sure you've studied it every night before you go to bed. But the significant fluctuations are, just the rental income is down, and normally you would see the HAP income go up. But what happened in December, the HUD funds the rental assistance program on a calendar year. So in December, we had met our budget authority. So they shorted us about $1.2 million in December for our HAP payments to landlords. But on the other hand, if you remember, we ended the fiscal year last year with about almost $5 million in HAP reserves from CARES money that we had gotten. So they're just kind of truing up that they don't want us to hold too much equity, HAP equity. So they're just truing up as of December. We were able to use some of the equity that we had on hand. But again, it runs through the current year operations like we were underfunded, but we actually had reserves on hand. So on that, the differences.
Can you hear me? Can you hear me?
Mm-hmm.
Emily, can you hear me?
Yeah, you're still live.
Mm-hmm.
Still what?
You're still a little hard to hear, so.
Oh boy. Okay, I tried a different approach, but I'll switch back.
We can hear
Anyway,
you. It's just very light, so if you can just speak up, hopefully we'll get you.
okay. But the $702,000 difference under HAP income, do we expect one way or another to make that up over the course of the year? I guess is what I'm asking.
Yes, they underfunded us about 1.2 on the HAP, but as of January, when our new budget authority started for the rental assistance program, now we're getting pretty close to what we're spending. So we're maintaining that, or even a little bit more for the first few months. And then the HAP payments that we get from the PBRA property is higher. It was about $500,000 higher than the what we budgeted, which offsets the rental income, which we've seen the COVID-related recertifications between the shift between the tenant paying and the HAP paying. So those will even out, we assume. So yes. And then there's a large variance between grant income and the program expenses, about $3 million each. And that was just, as you remember in the 2021 budget hearings, we had the additional $13 million that we got for CARES money for the CD programs. we just took that 13 million and just divided it out equally for 12 months. And I think just for the first quarter, we had not spent a lot of those funds. I guess they're ramping up. I just kind of went back and looked at it. So in the first quarter, we'd spent about $175,000 of those CARES money. And so that's just a pass through. So it's money in, money out, or money out, money in. But then in the next, just in the next 2 months, we spent almost $1 million. So we're ramping up those programs. Emil and his group are pulling, using those CARES money to give to the not-for-profits for the RFPs that they got. And so those will be trued up. Again, it's a pass-through, so it's an in and out on the income statement here, or the budget to actual comparison. But I just kind of wanted to point that out significant. It's not that we overestimated, it's just that it's a timing thing. So, any other questions on this schedule? I'll be glad to go through any of the other items.
Yes.
Okay.
Just one quick question. I don't know if Emil's on. Are there projections for the CARES Act money under the community development programs, CDBG and ESG, all the others, for those monies going out the door to the nonprofit? Are there projections of those getting to those entities within a timely manner? And what is that?
Emil had to jump off to another meeting with DEP, but we'll take that for a question. He should be back on for the board meeting.
Okay.
I know like I said, it looked like the first quarter we had just spent, of course, with the holidays and all, I know that there was probably a lag time on getting the contracts up and running, but we've have spent just like let's see, I have it for January through the 1st of March, we had almost spent over 800,000. So they are ramping up. So if we continue that, then that's 2 months, $400,000. So and I assume that it'll get larger and larger as the agencies identify the need out there for that funding. So, but Emil can probably answer that. I'm sure they have a plan. So.
And then the second one has to do with properties coming online for the development projects.
Mm-hmm.
Where in this would that be, income from that coming in? Where would it show?
Well, you there? So the rental income, of course, all the operational income will come in. So like with Mosley Manning, you get rental income, and then HAP income for the subsidized units. So that'll affect those numbers, increase those numbers. And then all the operational, if there's admin costs, associated with those property, which there are, manager, leasing assistants, any tenant services that we provide, utility costs, you see that has gone up. So that those costs, some of that is attributable to the discretely presented component units that are coming on board, along with the water rate increases, and then of course maintenance. All the costs will go. It'll be in all the operational side of it. So, and then of course the replacement reserves and principal and interest payments that on the debt of the property. So,
okay.
So it'll flow through the whole thing, really.
Yeah, it sounds like it.
So I mean, it's yeah. Mm-hmm. It's nice to have it all rolled up, but then sometimes the pieces kind of get lost. But yeah. Mm-hmm.
Yeah, I'm just trying to go back to the pieces.
Okay, and then so attached to this document, we included. I'm just kind of going to go through some visual aids to show the differences in income expense, and then add to contribution. It's this tiny little blue line here. We're trying to make it a little bit bigger. So you see the budget obviously is what we showed is a little bit more, but again, I feel like we've already trued that up in the 3 months after that quarter. So revenue by category, shows you, obviously, the HAP money is our biggest revenue producer. So just kind of an explanation and or visual of the differences there between budget and actual for 2021. Expense by category, same thing. Capital requests are included on here. They include what we had done as of the end of the quarter was some new roofs, put some new roofs on it, some of the units at Casey, and then I think one property had purchased some gators, so that's the capital requests are in there. Again, just kind of going down. Program cost includes. I kind of want. We did it after I thought about it after we've done this. I think I'm gonna next time break out the HAP cost, landlord payments out of the program cost, because it is such a large amount. It kind of skews what's it's actually. So I think that would maybe read better if you guys approve of that. Contribution, again, just showing the difference that will be made up in the next couple of quarters. And then the last thing is the let me get my notes here. The combined statement of net position. So this shows as of the end of December, the MDHA assets, liabilities, and net position, and the discretely presented assets, liabilities, and net position to get to a total. So just kind of some notes here. I talked about last week about the accounts receivable, tenant accounts receivable, which here we show it as net of allowance. So it doesn't look like a large number, because what we do is we allow for almost 100% of the receivable less the prepaid rents. So I just kind of, as a gross number, I picked out the receivables as of December 31st total for the agency gross for tenant was 1.3 million. So with an allowance of 887,000. So that was one of the areas that I spoke about last week about a concern, because of the COVID related receivables out there for tenants that I guess didn't get, or market rate and workforce and the subsidized that owe us money. But again, I think affordable housing is working with the agencies to help with the payment of rent. The other thing that I had on here was we had this cash amount here, this unrestricted cash amount. It includes the $9 million in the sweep that carried over from 2020. So after I feel like now that the audit is pretty much done and presented, so we can sweep that $9 million out into our strategic reserve account. So that 38 million there does include the 9 that's carried over. So this is kind of just, like I said, a combining what we used to call balance sheet statement of net position to show where we are as of December 31st. So anybody have any specific questions on this schedule?
No, Melinda, this was really good. Saul, I just got a quick question for either Saul or Gus. One of the big line items around, I'm just looking back at the very slide number 2, is that in our expense category, we're showing about an $850,000 positive variance due to these vacant positions. I recall discussing this when we actually started the budget process for 2021 in the past. Do we have any desire to actually fill these vacant positions? Are we actively recruiting to add 15 more FTEs to the agency?
I went. Okay, I'll answer. All right, Saul. Okay.
This is Saul.
Can you hear me?
Yeah.
Okay. Sorry. Just having a lot of technical difficulties today. I don't know if those are positions, and I'm assuming they're in affordable housing. I'm guessing most of them, and some maintenance and some leasing assistance. So my guess is yes, that we are constantly actively recruiting And that's our budgeted positions, and I think we tend to want to fill them. I don't know if Pat's on, she has more explanation on that or not. But I think we budget for all open positions being filled, and that's, you know, that never really happens. So I expect there's typically going to be a variance, a positive variance on this category. Melinda, that's correct, isn't it? That we usually bet that we, yeah.
I'll just speak to, so finance, of the 15, finance had 3 positions that we had budgeted, and we've currently, and so through the holiday, which is hard to, you know, hire people through the holiday, but as of the 1st of January, 2 of our positions have been filled. So I think a lot of it's just a timing difference. I know, like Section 8, and these are all admin positions. So affordable housing has 5, and those are mainly, like Saul said, leasing assistants, office staff, or directive office, central office. So those are mainly 15 positions in the central office or Section 8 admin and affordable housing admin side. So,
yeah.
Okay.
So can you just try to understand, because I'm going back looking at my original notes. What this was presented originally, Saul, and I know you weren't here, you weren't in this role when it was presented. We presented a budget that had a number of unfilled positions that were actually meant to be incremental positions to the agency. They weren't turnover positions, is how they were pitched. And effectively what has happened at the end of the last 2 reporting periods, we report that we beat our budgets, and the way that we beat our budgets was that we just didn't hire as many new people as we thought we were hired. It's how it's always been presented to the board. It was not presented as if these are turnover positions within the agencies. These are new administrative positions that really are overhead to the agency, is how this has always been presented. And so I'm not trying I'm just really just trying to understand that if we're looking at a period where we may or may not hit our contribution goals as an agency, not saying that's good, not saying it's bad, just as a statement of fact, is our plan to add another $1.6 million in administrative roles and effectively?
Yeah, we'll take a look at that. I hear where you're coming from, and so, you know, you want to be assured that we're going to make at least our contribution goal. If we're not, then one way of helping us achieve it is if we don't fill some unfulfilled positions. So we can take a look at that, report back to you on that.
Yeah, I mean, and again, it's just trying to understand as we look towards the end of the year. This is simple looking towards is where do we expect to end up? Just trying to get a sense of that.
Okay, gotcha.
All right. Any other questions for Melinda or Saul? All right. Well, I just want to say one more thing. This presentation of the financials was exactly what I was looking for. So I just want to thank you so much for working with us to make this really easy to understand and to follow. And I particularly really like my budget line piece. So thank you, Melinda, for creating this journey.
I forgot about that. Yeah, it was in the packet. Yes, exactly. Yes, that's a guide to what's included in the summary line. So if you have a question, so because there's several different things depending on what line it is. Several different things go into that line. So yes, that was Emily's idea.
Thank you for that. Okay, so we can move on now to the next agenda item, the cash investment policy.
I think
So
Jim Filgen, is this you?
Is Jim T on?
Okay. I think we sent out the cash investment policy to the board members, and we had some revisions on it within the last week or so. I don't have it to do a screen share right now. Matt, I'm not sure if you have it. Basically, we have 2 or 3 major constraints in terms of what we do. One is we're a governmental entity, So we're kind of restricted to somewhat by HUD regulations, but a lot of those have gone away. But we're also restricted by the state in terms of the allowable investments that we can do. We also have a situation, given that we're basically in housing, we have to have a certain amount of liquidity in terms of our investments. And even though, for example, in the reserve accounts, we have something like $50 or $60 million, that's not one pool of money. That's a pool of money for each one of our properties. And if a property needs re-roofing or something like that, it's not like they can borrow the money from another agency, but it's something that they have to fund themselves. So we're looking at quite a bit of liquidity in terms of what we're trying to do in our investments, and then finally we're looking. Given those constraints, to kind of see what we can do in terms of investment return. One of the things that we were kind of realized over the last couple of years, when interest rates had gone down quite a bit, the banks are not interested in doing certificates of deposit that they have to collateralize. There's a certain expense for them for doing those, and so they kind of back off. At one time, we were going out and we'd get bids from several different banks that were interested in our deposits. What we found both in this program and also in our insurance program we have for the state pool, we talked to banks about certificates of deposit, and they said we're not interested in bidding. So what we've kind of gone to some extent is we have a lot of money in cash deposits with our lead bank, Pinnacle, and they're giving us, I forget the formula, but it's like 25 basis points over some interest rate with a floor right now of 42 basis points. And that's about as good as we can get for other investments. When we look at the state provides a local government investment pool for agencies, for local governments across the state, where they can put their funds in and have the state kind of work out investments for them on a pooled basis. And I'm thinking that for February, they're down to 10 basis points. About a year ago, it was 1.7% interest, and that's really kind of gone down an awful lot. So when we compare the local government investment pool at 10 basis points, and our lead bank is giving us 42 basis points, we're doing better, a lot better. The other advantage that we have with the investments with the lead bank is also we get a lot of other services, things like wire transfer fees are waived, account maintenance fees are waived. So we're getting a lot of benefits in addition to the 42 basis points that we're getting from our lead bank. I'm trying to think if there's anything else kind of beyond that. If we ever do get to the point where interest rates go up, I think we would get back to the point that we would ask banks, which banks are interested in bidding on our deposits. And like I said, we did this, several years ago, quite a few years ago now. And what we try to do is have a kind of a ladder of investments, so that every Wednesday we had some investments coming up, and the banks would bid on those. If interest rates do go up sometime in the future, we probably go back to that, at least on a limited basis. And like I said before, one of the constraints we had years ago, we had one pool of MDHA cash, and now we have each one of our properties has their own reserve account. And so it's not like we have $50 million that we have out there to invest. We have $2 million here and $3 million there. So to maintain liquidity, there's not an awful lot we can do in terms of having long-term investments. So with that, let me kind of open and see if there's any questions about what we're doing or why. or any suggestions about the investment policy.
Thank you, Jim. Any questions?
No, Jim, this was good. Can you just quick, we basically went out to RFP, if I'm not mistaken, and basically Pinnacle was really the only bank that responded to us with any material terms. Is that correct? Maybe about 2 years ago?
I think it was more than that. We try to put out the lead bank about every 5 years. And I think because of the COVID thing, we extended Pinnacle Bank for 1 more year. So very likely we would be doing that sometime in the near future.
Mm-hmm.
So Pinnacle, we've had Pinnacle 2 times now, and they charge us 0 fees,
Mm-hmm.
which has been a huge benefit for all of the things that we do. We currently have about 80 bank accounts now with the PBRA and the discretely presented component units, because all the discretely presented and blended component units all have to have their own separate security deposit account, operating account, and replacement reserve account. So, so yeah, there's a lot of accounts. I'm not looking forward to putting that back out for bid. So, and our audit does come up again. It comes up they both are on the same rotation, unfortunately. So we extended both the audit and the banking last year for COVID. So they both will be coming up this year for bid. If we choose to do it, maybe we don't. So.
Got it. And so are we really saying is that we're getting 42 basis points on all of our investments that are effectively FDIC insured, and we're earning 42 basis points on it? Is that, in essence, that's a good deal? That's a good deal. If they're all insured, there's no liquidity risk to it, and we're getting all that. That's really good.
Yes.
Mm-hmm.
Yeah, Pinnacle has been really good to us, and we've got at each site, just to kind of pile on, kind of offset off the cash investment, but at each site we have a remote scanning machines, so that the managers and leasing assistants are able to scan deposits every day for free. So yeah, they've been really good for us. So.
No, this is pretty favorable given where conditions are today.
Madam Chair, this is Bill Purcell. May I ask a question?
Please.
I understand, Jim, that this policy was provided to the Metro Finance Department for their input and review, and that they provided comments and you have incorporated those into this document.
That's correct. I think they came in and wanted us to kind of highlight the fact that we're looking for security, liquidity, and yield. So I think someplace in there there's a SLY, which is something that they suggested we kind of highlight in our policy.
And I don't believe that the board has in the past formally approved this policy, and I don't think you're necessarily asking for that approval. This is just for review. Is that correct?
That's correct.
Thank you. Thank you very much. Thank you for all the work on this.
All right, are there any other questions or points of clarification? Well, thank you for that presentation, Jim. And Pinnacle really is being good to us, so it's good for us to know that. So next up on the agenda is the DBE update.
Okay, so this is Buck. I'm going to pick this up. Saul, I saw you reaching for your phone. Did you want to make any leading comments?
No, can you hear me though?
Yes. Yeah, we can.
No, go right ahead. Go right ahead, Buck.
The DBE slides were sent out with a little bit of time for you to read those. I'm not going to walk through them because most of them are a rehash from the strategy meeting that we had in January, the offsite. Slides 2, I'll show it to you. I'm sorry. So do you see those slides?
We see slide 4.
Okay, yeah, so I will go up to slide 2 is the recommendations from the December 8th brief that we went over at the offsite. That is what we learned, and we talked about this at the board retreat, what the disparity study does for us. It allows us to procure, to set goals and incentives with a race-conscious approach. So the recommendations from the staff going forward are, it's not an either-or proposition, but an and proposition, is that option A would be, we conduct a disparity study following those major tasks, procure a firm to do the disparity study. Once we get those, we can set goals, establish incentives, and then create a business assistant office to manage the process. Of course, that comes with the cost of time and some dollars. Option B, which we can start today, is compete and procure a DBE consultant. That DBE consultant firm will help us. We have those per project, but we would like to have a DBE consultant firm that works directly with our procurement staff on smaller items, not just the major projects. And then that DBE consultant firm can help us recruit race-neutral firms to bid for our projects or our smaller work, and identify the firms that are out there that maybe need a little help. From earlier discussion, we talk about some of these DBE firms that are disadvantaged because they don't have the cash reserves to carry them for 60 or 90 days to buy materials, pay their labor, and then get repaid in the normal contracting to pay app procedure. So in some cases, DBE firms can't compete for larger jobs because they don't have the cash reserves, or they don't have a record of performing that work, so they can't get a bond. So a surety won't set them up at an affordable price. So maybe if we know those firms that are sort of at risk for lack of surety, we can make that part of that work unbonded, or we can assist them with getting bonds if we do want to have bonds to back up the payment and performance of that work. So that DBE consultant element would help us to do that. And then, you know, part of this, in addition, this is sort of in the brainstorming side of the equation, that MDHA could set aside some funds from our strategic account to help those firms be more competitive with either their cash reserves or their bonds by, you know, giving them a grant or giving them some low interest loans to get them through a job to help them compete. And of course that would come at MDHA risk, but it's not a loan. It's not, we're not getting into other competitive banking models. It would be something to help those folks, but more work to be done from a legal side to make sure that's possible. So from a staff perspective, I don't know that any of these things need committee or board approval at this time in place. I think we could do option B and inform the board or the committee right now that we would like to move forward with option B and begin that process of procuring a DBE consultant firm to assist with this and establish more procedures as we go forward with that. And then we could bring, based on discussion from the committee here, maybe we can start the process of considering a disparity study with the follow-on ramifications of some cost, fully explaining that to the committee. So I'll pause at this time for comments or reflection.
Hey, Buck, just to make it clear to everybody, we did, Will Chopin did take a look at, from a legal perspective, whether we could use a disparity study of Metro or another sister agency. Is that correct?
Yes. The Metro disparity study, it contains a lot of detailed statistical information regarding the Nashville marketplace and disadvantaged business enterprises ready, willing, and able to perform work for the Metro government, but it did not look at MDHA procurements. Therefore, we would not, while the disparity study may provide useful information to MDHA, we would still need to do our own disparity study.
Right. Okay. So it's fair to say that with the disparity study, as Buck pointed out, we could actually set numeric goals, which otherwise would be unlawful. And so that's the major advantage of doing the disparity study. Obviously, the disadvantage is it's $1 million not going into housing. So I guess from the staff's perspective, given the data that's out there on DBE firms and some of the other things that Buck mentioned in this slide, we would recommend that at least for the initial period of time, we start up on option B, see how much we can improve, and then keep option A in reserve. Is that fair to say, Buck? Or
Yes, I think we can look at our data over the last quarter, over the last couple of years, and continue to improve how we're performing with the DBE consultant. Or we can start option A and option B if you can still see this slide. It doesn't, just because we go out and procure a company to do the disparity study does not obligate us to follow through with that study. But for sure, I would recommend that we begin with option B right away.
And we actually had a DB consultant in the past. Is that correct? We're not really sure what happened.
Yes, we've had Gwen on our team in the past. I can't think of Gwen's last name all of a sudden, but yeah, we've had a DB consultant assist us. She's now with Metro Nashville Public Schools as one of our primary clients.
Madam Chair, could we stop sharing the screen so that the committee can look at each other?
Yes.
This is Bill Purcell. Quick question for Buck. Do we have a sense of when Metro, and for Will, when Metro last did their disparity study, and whether or not the next time they do a disparity study, we could piggyback onto their disparity study instead of there being two $1 million studies conducted at the same market at the same time, whether or not when Metro does their disparity study, they could simply include us as a smaller portion of their inquiry, possibly saving us both money. And so it's a question, is it doable, and when might that happen?
So Buck, the date of the latest Metro procurement study is 2018, which I'm sure about, and I believe you're sure about as well. What I'm less sure about is it covered the time period of 2012 through 2017. And what I don't know sitting here today is when Metro did a disparity study before 2012. What I just don't know. But Chair Purcell's idea about MDHA piggybacking or jumping onto the next disparity study, if and when it occurs in the next few years, that there is possibility to that, I would say. As long as MDHA procurement is within the purview of the disparity study. But I don't have an indication of when Metro is going to do another disparity study.
That is something we could find out, and we could actually begin discussions with Metro about that possibility, I would think.
Yes.
Yes, we can.
The intergovernmental affairs person, I'll say yes, we absolutely could speak with them about that. There is not a regular schedule. There had been quite a period of time before the Griffin and Strong study, but there was a commitment at the time stated to sort of make that a more frequent process. And I'll certainly get from Metro sort of if and when they expect to do one again.
Thank you.
So I've got a couple of questions about this in process. So a study was done by Metro. It has information in it. It's not been reviewed by the agency staff to study it, to see if there's information that could be gleaned to help. So there's information that possibly could make a difference to us. There's time and money that needs to be directed to do that, seems to me. There's also value. There's no regular schedule, as we understand, on the Metro government side to conduct these studies, although this is a pretty recent one, the 2018 one. So there's some unknowns here. So we could proceed with option B, knowing there are these unknowns, and try to get these questions answered. Seems to me is the direction that we're heading, that you know, why would we not go back and utilize information from that study if it exists?
Well, yes, ma'am. We reviewed their disparity study. The question becomes whether our procurement procedures or their procurement procedures, two different bodies of government, that a couple of standards of law is there has to be pervasive, systemic, and obstinate discriminatory conduct. And so for Metro, they showed that there was those three tests, and that then the other part of the disparity study is finding whether there is a significant statistical disparity between the number of qualified minority contractors willing and able to perform the particular work and the universal body of contractors. So there's two elements of the study that have to be validated, one on the procurement staff, and secondly on the universe of contractors that could perform that service or that work. And so the disparity, like I mentioned before, they're very complete. The one for Metro was 385 pages, and it gives you a really good data about who in your region can do that work and what is the proportion of those folks that are MBE, SBE, WBE, and so it really informs the procurement staff who is in the area that can do that work, because that's part of their overall assessment to determine if there was discriminatory action by a procurement staff in the past.
And we will use, in connection with option B, so to speak, we will use that data, that availability, who's out in the market, that kind of thing, to help guide us. That's what the advantage of having that study is, that we can still take advantage of it. We just can't take advantage of it in the way that Metro can.
Okay. The other side of this, having worked in this space and tried to work with contractors who could be DBE contractors, and we use a lot of minority contractors, but they hadn't gone through all the steps because they said it was too much work, too much trouble, too expensive. They didn't have enough time. They just needed to do the work. So that whole capacity side of things on the part of those firms is really relevant for that's why they can't, won't, is because they don't have that capacity. So in terms of cash reserves or the expenses that are required to meet the requirements of, these kinds of jobs. So to me, focusing on that piece of it would give us a lot of bang for our buck.
Yes, ma'am, we agree. Sometimes we don't know who those folks are that decide not to compete because we're, particular service, we're not out there, and we're counting on that DBE consultant to help us find those firms that are right on the edge and said, if I just had one more little thing that you could help me with, I could compete and I could do this work in a race neutral way. We can do that right now without a disparity study, and we would recommend going forward with that as soon as possible.
Okay, thanks.
Any other questions?
So, the only other item, Madam Chair, is I do have the data for the last quarter. It's in the slides. I can go over that, or it's up to you.
Yes, I was looking at that. If you'd like to just briefly highlight it, Buck, please feel free.
Madam Chair, just for the record, Commissioner Coleman from the Development Committee has joined us here at the Collaboration Center.
Thank you.
So just what's new on this chart is the 2021 Q2 award, which is we've adjusted our quarter and fiscal year system to be with Metro system, which is July 1 through June 30. So 2021 Q2 was October through December of the past year. So you can see how Q1 and Q2 that we're already ahead at the mid-year point. We're already ahead when you combine those two numbers. We're ahead of where we were for the whole year for 2020. And so projecting that over the whole year of procurement, we're looking at better than 10% MBE, 12% women-owned business, and SBE is around 6%. Any questions on this snap in time?
No, I'm glad to have this information. Thank you.
Thank you, Bob. Good update.
So at this juncture, what I've heard is we will speak with Metro and find out when they will be pursuing a disparity study. And that I think that it sounds like we are all in general agreement that we should be pursuing the work under option B. And that there's more for us to firm up and clarify when it comes to how we would handle things related to grants or loans or more direct assistance. So with that, I assume that you all can proceed and come back to us with an updated report in the future. I do want to acknowledge that I have very much appreciated how seriously staff and our interim executive director has taken this issue. And so it's great to see this progress and the thought that you put in. Any other comments from commissioners? All right. With that, I think we can move forward on the agenda. Is there any old business to address? Hearing none, is there any new business?
There's one item of new business. Matt, do you have the ability to share that letter from citizens? Just some good news that the finance team.
Yes, just give me a minute.
I just thought we'd share this just really briefly. And Jim T, do you just want to kind of explain what this is?
Yeah, this is a letter that we received from Citizens Bank. Actually, they sent one version of it some months back, but we asked them to send one to our board. They are very pleased with the fact that we've maintained some deposits with them. They probably came in, I want to say maybe it was a year ago, and the president of the bank came in and kind of met with myself and Melinda and Charles Pope about our deposits and really explained that our deposits were critical for their capital position as far as maintaining their operations. And so based on the discussion we had with them, we decided to maintain the deposits that we had and continue them kind of going forward. This was kind of a letter kind of explaining the fact that how appreciative that they are for the fact that we have maintained those deposits with them. And I might kind of mention, and this, like I say, was maybe a year or so ago that they met with us, and we had some deposits in what they call CDARs, which is a deposit where they kind of farm it out to other banks, all of them, but right below the FDIC insurance limit. And right now, that's, even though we're getting 42 basis points from Pinnacle Bank, I think we're getting maybe 1.5% from these CDARs. So it is being beneficial to us, but it's being very beneficial to the bank in terms of those CDARs count as part of their capital for the hoops that they have to jump through.
And I'll just add one quick note. I happened to have a call with their chief credit officer yesterday, actually, about an affordable housing project that he's working on. And he commented again on how helpful it's been working with MDHA. But I think more importantly, I think we can all be excited that Citizens Bank has had a really strong turnaround and on their own, separate from us, is really doing extraordinarily well right now and is a huge success story in the national banking market.
All right,
That's
thank you,
wonderful
Matt.
to hear. Thank you for the
Thank you,
update.
Matt and Jim.
Any other comments or new business?
No, Chair.
All right, hearing none, I think we can motion to adjourn. Is there a motion?
So moved.
Is there a second?
Second.
Thank you. Will?
Okay, all those in favor of adjournment, say aye.
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 Is there anyone opposed to adjournment? Hearing nothing, you can stand adjourned.
See you soon.
Thank you.